Folks, thanks for coming today. Today we're going to talk about how to reduce your insurance costs. First of all, we need to talk about the increase in coverages or costs for coverages that have been happening. If you take a look at your handouts, you can see that premiums for commercial insurance went up by 20% over the last year. And also you can see the health insurance costs keep going up also. So both for property and casualty and for health, the premiums are continuing to rise. And there are some reasons for that. Basically, for example, if you're in a car accident, the cost of getting the repairs, the labor have all gone up. I used to be able to price coverage for a home at, say, $175 per square foot to replace that. Now it's up to about $250 per square foot because it's hard and the parts are more expensive and labor's more expensive. Why do we need insurance? What is the driving force? It's mainly through contracts, isn't it? Landlords, vendors, and customers. And oftentimes when you're dealing with that other party, they have a standard contract. And in that contract, they have what they feel and what they want as the maximum coverage. So one of the things that you can do is to go and negotiate with them, okay? For example, in your lease or your contract, it may say you have to have $1 million of workers' comp. Well, in Virginia, you only need $500,000. So the first place to look at is the contract itself and say, do we really need this amount of coverage? For example, they could say, well, we want $1 million of automobile coverage. Well, I don't even have an automobile. See, it's just this standard boilerplate language that's in there, and unless you go back to them and negotiate it, say, do you really need this coverage? And you see this a lot with landlord contracts. They just have all kinds of insurance requirements in their contracts that can be negotiated. What else can you do to lower your costs? Well, when it comes to E&O claims, that's where, say, I'm a plumber and I'm negligent in doing the work, or in some other field, basically you can write in your own contract limitations as to what your liability is, and that would reduce your insurance costs. For example, you could say, well, I'm only going to be liable to the amount that you paid for this product. So for example, let's say I bought a coffee cup and something happened and it injured me. That language would say, oh, I can't sue them for all the damages that I have. I'm limited to the price of the coffee cup or the price of the service, the auto mechanic or the person who put the fertilizer on your lawn and destroyed the lawn. I'm sorry, yes, I know it will cost thousands of dollars to replace your lawn, but I'm only limited to my damages to the cost of the service that I provided. In fact, I remember once I was told that a family took their dog to the veterinarian, and the treatment, they disagreed with it, and they thought that the veterinarian didn't do a good job. Well, the statute in Virginia apparently is if the veterinarian doesn't charge you for that visit, there's no liability. You can't bring a lawsuit. So that's one of the things that you can do. Now, what does that do? When you have that kind of language in there, then instead of saying I need $1 million of E&O, because I've got that sort of limitation, I can drop down my cost to my coverage to maybe $300,000. Okay? So simply by, first of all, looking at the overall contracts, what's in that contract, is that insurance really needed? And then by putting my own limits in there, I can possibly reduce my coverage. Now, if you want a really great example of this, look at your lease. The landlord has all types of language in there that limits the landlord's liability. For example, you'll see in there, the landlord is not responsible for any injury to the tenant or their guests or anything unless they're grossly negligent. Well, there's really no definition of grossly negligent, and if you try to change that to the word negligent, because that's really a lower standard, that's the normal standard, they balk at that, okay? So there's all kind of language that the landlords put in there to protect themselves. And how do they do that? Via a contract. Today I wanted to talk a little bit about health insurance, because that's been one of the issues that have been on people's minds. one of the first ways that you can look to reduce your premiums for health insurance is the type of plan that you select. You have, first of all, like the PPO or the HMO. For example, Kaiser Permanente would be a good example of an HMO. And where that is they have a network. And if you're in Kaiser's network, then you go to see their doctors. Okay. With a PPO, you have not only the choice of staying in network, but going out of network. And you'll find that the costs are lower for health insurance if you go with a HMO. The next area that you can help in reducing your costs is the deductible. Okay? When I first started in public accounting back in '84, the CPA firm that I worked for covered all the premiums and they covered all the deductible. So it gives you an idea how things have changed over all these years. The next area that you can work with is tax plans. And let's go over some of these tax plans. There's something called a health savings account. And with a health savings account, and with other of these plans we're going to talk about, we're taking people's salary prior to them being taxed on it, pre-tax, and using that pre-tax money to help pay for the premium. So in today's world, what you have with health insurance, the employer is asking the employee to help pay for these premiums. And one of the things that the employer can do to soften the burden is to say, well, I'm going to set up a plan, employee, so that you can pay your share of the premium with pre-tax dollars. See, that's a wonderful, wonderful program. Now, also, they have flexible spending accounts for other types of expenses, just prescriptions, medical visits, that type of thing. If you look at your handout here, we can take a look at the differences between the various options available to you. Now, the one thing about the health savings account is it has to be, if in order to be eligible for that, it has to be linked to a health insurance program that has a high deductible. Okay, that's critical. You can't have a savings account unless you're involved with your employer has a plan that has a high deductible. So in other words, the high deductible is used to reduce the employer's premium, and as an alternative, the IRS says, well, we're going to let you set up a health savings account. And so basically, what are these high deductible? When does a plan become high deductible? For an individual, if the deductible is $1,600, then that's a high deductible plan. For a family, it's $3,200. So what does this mean if I'm in a health savings account? And you can set these up with many people, like Schwab has a health savings account. What it means is I can take either myself as the employee or the employer can contribute to my health savings account. And in this year, it's $4,050. So what does that mean? That means pre-tax dollars I can put in my health savings account. And when I go to use that money, I take it out to pay for a prescription or a doctor's visit, there's no tax. So that's a great program. And if I'm over 55, it's an additional $1,000. So that's over $5,000 a year that I can set aside in my health savings account. For a family, it's $8,300, and if you're over 55, an additional $1,000. Now, the other nice thing about the health savings account is that's your account. So if you were to go to another job, you can take that with you. And you can invest the money as you choose. So if you wanted to buy IBM stock, you could do that. Now, the health savings account is a lot like an IRA. Has that same sort of a feel, doesn't it? And in fact, at a certain age, I don't even have to use the money in my health savings account for medical expenses any longer. At the age of 65, I can take the money out of that health savings account that I've been building up all these years, and I could go buy a sailboat. Okay? There's no penalty. I just pay tax on it. All right? Now, if I try to take that money out to buy a sailboat before I turn 65, then there's a 20% penalty. So we don't want to do that. But the main thing about the HSA in that column is that either the employer or you can contribute to the HSA. You keep this money It's your money. The next one is the flexible spending account. All right. And you say, well, this too is a program where you're going to fund this prior to paying taxes on it. And at the beginning of the year, you tell your employer, this is how much money I want taken out of my salary to fund my flexible spending account. The one thing that sometimes you'll see towards the end of the year as you're driving along, the optician will have an ad or something. Hey, come in and get your eyes checked out before the end of the year. Why? Because at the end of the year, your flexible spending account money goes away. So you've got to use it or lose it. Now there is some carryover, okay? You do have the option to carry over some of that. It's about $640 a year for $660 for 24 to 25. Now, the flexible spending account actually is called a cafeteria plan. Isn't that a great name? Why is that? Because it was offering employees pre-tax dollars to pay for various items. It could be used for medical. It could be used for daycare. See, that was the cafeteria, the flexible spending. Now, if an employer doesn't want to go to that whole list of options to provide, they can go under the flexible spending program, something called a premium-only plan that just focuses on this plan just for health insurance. And it not only benefits the employer, it also benefits the employee. Let's take a look at an example. If you look over here, and I love these names, it's called a POP, premium-only plan, and it's a type of flexible spending plan. And let's say the employees elect to take $15,000 of their pre-tax dollars and put it into the flexible spending plan. What's the result? Well, here with the POP plan, the employer, the good news for the employer is they save money too. Not only does the employee save money, but the employer save money because that $15,000 that they put into their POP plan is not subject to payroll taxes. So here's our example. With the POP plan, the actual taxes that the employer pays is $285,000. The FICA tax on that's $21,000. If you didn't have the POP plan and the employees didn't make this election, the payroll would be $300,000. The employer's payroll taxes would be $22,950. So you have a savings here just by the employer having this plan. And of course, if you look at the employees, let's say they're in a 22% bracket, then of course on $285,000, that's the $300,000 less the 15, their tax is $62,700, but if they didn't have the POP plan, they would be paying $66,000. So the employees themselves are saving $3,300. So this is another avenue to get our insurance costs down. Now, let's talk about the HRA, health reimbursement. And here, this is something that on the employer, on their own initiative, it's not an employee-based program, it's totally an employer. The employer says, you know, gee, health costs are getting rather high. I just want to adopt a plan to say give every employee $1,000 to spend towards health insurance. And you say, well, Art, that sounds a lot like the health savings account, doesn't it? The difference is, the main difference is the health reimbursement doesn't have to be tied to a high deductible insurance program. Remember when I talked about the HSA, it has to be tied to a high deductible plan? Not so with the HRA. And do remember that you don't get to take the HRA money with you. Okay, that stays with the employer. So we've talked about the insurance and the different options that we have there. We talked about possibly changing from a PPO to an HMO. And I want to talk to you next about something where, and you see this a lot, say in a closely held business. Somebody is a consultant and they've got a family and their insurance costs are high. And they go, how can, and normally that's deductible on your Schedule A. And people can't use it because the hurdles are so high now on the Schedule A, it doesn't do them any good. Here is a program, it's called a medical reimbursement plan. And basically what the medical reimbursement plan does is this, and I'll give you an example. Let's say I had a consultant and his family medical bills are, say, 20-some thousand a year, which isn't atypical. It doesn't do him any good on his Schedule A. He gets no benefit. Instead, what he does, as a sole proprietor, he can't deduct those medical insurance costs on the Schedule C. But if he hires his spouse or her spouse as an employee and offers this plan to the employee, well, then it is deductible. And not only is the employee covered, but the family is covered. So in other words, you have backdoored, you've end around the limitations by hiring your spouse. You're now able to take those medical deductions that I was not able to use on a Schedule A and move them over to a Schedule C, which is, you know, when you think about it, that's an extra $20,000 deduction. It could be, especially if you have young children. And what else does that do? Not only does it reduce the income tax, we're reducing your self-employment tax. So it's almost like 40 cents on the dollar, maybe more, that we're saving simply by adopting a medical reimbursement plan. Yes, you have to have an agreement. You have to spell this out. And your spouse has to do some work around the business, which it doesn't require a lot. All we're really looking for is some part-time work, $4,000 or $5,000, $6,000 in salary a year. And that would be enough to say, well, that's what they're doing. And by the way, we offer this benefit. So it's a wonderful idea, medical reimbursement plans. This is also available for partners, okay? Partners, but you would have to hire your spouse. I know that sounds kind of backward, but that's the way that technique works. So we've looked at the medical reimbursement plan. Now, another question comes about eligibility, okay? In other words, the owner of the business wants to have health insurance, but oftentimes, not only with all benefit programs, whether it's retirement plans or health insurance, the employer is trying to reduce the amount of benefit or the retirement funds that are going to the rank and file employees. With health insurance, you can do some of that, okay? You can do some of that, but generally speaking, you have to treat everybody the same. Where you can have some demarcation is, say, full-time or part-time. So you could say, we're going to be offering health insurance to the full-time people, but people who are only working 10 hours a week, we're not going to offer that. You can do different programs for salaried versus non-salaried. You can do it based on seniority. Okay? So these are some of the ways that you could reduce your health insurance premiums. One of the areas that you could reduce, another area, is join a professional employer organization. You hear about these every now and again, but what is a professional employer organization? Basically, I take my company and my employees and I join an even bigger association of thousands of other employees. And by doing so, that group gets a lower cost for their insurance costs. Okay? That's a wonderful benefit, and I put in a handout here. They're, like, for example, ADP, the payroll company, they have this available as a professional employer organization. And it really saves the possibility of getting a better program for not only health insurance, but other benefits as well. So that would be one of the areas, another area that you would want to look at to reduce your health premium costs, is to join a PEO, a large group. Finally, there's a difference when we're talking about health insurance, brokers and agents versus casualty, property and casualty agents. It's a little bit different world. And so that would be another good source to go to, because they're very knowledgeable, to go to a health insurance broker to see what they could do for you. And as, for example, there's one here in Arlington. His name is Steve King at Capital Benefits, and he's very knowledgeable in this area. Now that we've talked about medical insurance and how to reduce those costs, let's talk about property and casualty. The first thing I'd like to talk about is the type of agent that you're going to see. There's independent agents, and then there's what's called captured agents. And what's an example of a captured agent? That would be like Allstate or State Farm. If you go to a State Farm or an Allstate or a captured agent, they can only sell you their product. Unless, for example, State Farm doesn't insure that type of product. Say, for example, you have an alligator zoo, and State Farm says, no way are we going to insure any alligator zoos. In that case, that captive agent can go out and look at the market. But other than that, they're really enclosed as to what they can look at. So one of the ideas maybe, if you're shopping, is to look at an independent agent. That would be a good choice because they can go out, they have no real preference, they're just out shopping for you, and that's a good thing. Another area is when it comes to commercial vehicles is looking at the coverage. First of all, is it an old vehicle? In other words, is it worth the cost of collision and comprehensive coverage for that older vehicle? And when you go to buy a new vehicle, you have to consider that if you get a loan on that, that lender is going to require you to have collision and comprehensive. And now you're talking about a vehicle, just a pickup truck costs $100,000. You see a brand new pickup truck? So that's one of the first things you want to look at is what is the cost of this going to be for this brand new vehicle. In the last couple of weeks, I've had people call me who are at the dealer. They've already bought the car and they're looking for insurance. And because of the accidents or things, the premiums are such that it just made the car unaffordable. So it can be a real shock for people when it comes to new cars. Of course, another way to save on property and casualty for your business is to increase the deductible. That's whether it's general liability, commercial vehicles along the line. You can say, look, I'll self-insure instead of $500, I'll raise it to $1,000. Now, one thing I want to mention about insurance, and one way to keep your insurance premiums down is claims. People sometimes make claims for the smallest things. They think, well, it's insurance. I want my porch fixed, the handrail fell off for the storm, and I'm going to call up Travelers or Geico and have them pay for this. Well, there's two problems there. One is oftentimes these things are under the deductible. So they're not going to help you anyway because it didn't meet the cost over what you agreed to as the deductible. The second thing is that once you make that claim, even though they didn't pay on it, it goes into the records and it goes into the risk factor. And so now it's on record. And you think, well, I'll go over to Travelers. I made the claim with Geico. No, believe me, the one thing you can count on is these insurance companies, they talk to one another. They report those claims and they all tie into the same database and they find out about those claims and they do not move on them. So they know about that. They talk to one another. I want to come back to the PEO again. Remember how we talked about that for health insurance? But it also can cover other things too. It can cover workers' comp insurance, and of course they can cover health insurance as we talked about. And why do people join these PEOs? It's because they can get better pricing on their insurance. Also, PEOs, why do people join them? Complexity. It takes all this complexity of dealing with the employees and shifts it over to this other company. They deal with all those issues of compliance. So that takes it off my shoulder. So if I'm a brand new company, I've got so many hats I'm wearing, I'm trying to get things done. Maybe I've got employees in New York or Tennessee. What are the requirements in those states? Well, I have to, in other words, all the other things I have to do now, I have to be the payroll person too. And so if I can shift that over to a PEO, that would be very helpful. Also, they may be able to get a better rate and they may be able to offer benefits like 401k plans. Now, one thing I want to mention is when you're dealing with 401k plans or health insurance plans where the employee is paying part of it, it really pays to have that together with your payroll service, integrated. That way the money comes out automatically. And that's one thing I'll mention to you when it comes, for example, workers' comp. There's two ways to work workers' comp, to function workers' comp. You can do an estimate at the beginning of the year of what your premium's going to be. And then at the end of the year, you have to get all your 941s and all that documentation and send to them so they can see what the actual cost was compared to what you projected. Then you either, and most likely you'll have to write them a check. You go, oh my goodness, now I've got to write them a check for last year to catch up, and then I've got to write them a check for this year. So one option is to keep your headaches down, is to have your payroll integrated with a plan where it pays as you go. Every pay period, if you pay twice a month, then on the 15th, they say, hey, okay, this was your payroll, this is your class codes, we're taking this money out for workers' comp, and that's the end of the story. You don't have all this paperwork at the end of the year. So I would suggest, for simplicity's sake, and that's a good idea. The other thing to think about when you're thinking about these PEOs is, okay, Art, that sounds like a great idea, but before I go there, you want to make sure that they actually will cover your workers' comp in that big group. This big group that I'm about to join may go, you know, Art, we see that you are in the mining business with dynamite. We don't want to pick you up. So that would be a reason why I wouldn't join that group. That's not going to benefit me. Say, it's not going to benefit me. Multi-state businesses, that would be another reason to join. Also, trade associations. Trade associations can be a very good source for policies that meet your industry, and that carrier one already knows your industry. Say I am in the mining industry and I join the Association of Miners. Well, there's an insurance company, most likely they have a relationship with an insurance company that knows about the mining risk. So first of all, they know what coverage I should have, and then secondly, they have priced it economically. And one of the reasons they've priced it economically, because I'm a member of the Mining Association, and we're all there together, and they're going to give us the best premium that they can. So I would suggest thinking about trade associations to keep your costs down. The next thing I want to mention about is commercial vehicles. When you hire a driver, you need to look at the motor vehicle report to see what kind of accidents or tickets they've been in. For example, if you don't do that and you hire a driver that's had accidents or tickets, it's going to drive your premium up. So the first thing you do before you hire an employee who's going to be using one of your commercial vehicles is to check and get their motor vehicle report. Now, that driver may say, oh, I have a totally clean record. I've been driving for Staples for 10 years and I've never had any incident driving my commercial van for Staples. It doesn't matter. If that same driver had a ticket or an accident taking his family to the beach on a personal trip, it's counted the same. So you need that report to see what's going on. The next thing up is where you start your business. Some insurance companies, for example, in DC, they don't like to insure businesses in DC. Okay? So one of the things is you might say, well, I'm just going to have my business in Maryland because I can get my insurance there. I'll have more options as far as costs and opportunities. Now, when we're talking about insurance, people will say, well, I need general liability insurance. General liability insurance covers people who come in and slip on the floor and injure themselves. But it doesn't cover for my negligence, does it? So for a lot of people, their risk, say for example an architect, their risk isn't that their customers are going to slip on the floor. Their risk is negligence. and they need errors and admissions for that. And it's not only professionals, it's not only like architects or lawyers, it can be in any field, okay? That really what their real risk is some type of negligence, that they've done something improper and injured the other party. So that would be one of the key things there, is to think about what type of insurance you need. Also, I'll just mention to you about the difference between general liability and a policy called the BOP. Don't you love that, BOP? The general liability, the BOP policies, the insurance companies say, look, we know about hair salons, and we know about hardware stores, and we know what the risks are there. We can offer a broader array of package. We can not only offer general liability, but we can offer property, and we can bundle it together. And really that's a savings in cost. So sometimes if you can, you want to get a BOP policy, you get more coverage for less money. And also, if you have multiple needs for multiple, try to stay with the same insurance company, okay? That way there's no gaps in coverage. One insurance company can't point to the other. Also, when it comes to your automobiles, let's say I am a real estate agent, or I have a booth at the farmer's market, and I make deliveries, baked goods, to my customers. And I'm driving my personal vehicle on personal coverage, and I get in an accident, there's no coverage. Why? Because the insurance company said, well, you're using this for a business purpose. Business purpose is a whole different risk than personal coverage. Now, I'm not talking about commuting, but I'm talking about where I'm using my vehicle for deliveries. So you need to think very hard about that, because they will just zero out the claim right there and not give you any coverage. Workers' comp. Classification is very important. You can talk to an agent and they can price you a very low quote, but they may have put you in the wrong class code. There's a different class code from an office worker versus a person who's up on a roof, isn't there? See? So if they just push you into the wrong class code, and remember, at the end of the year, that auditor is going to be coming through and they're going to look and they'll go, hey, you're in the wrong class code. You should have been in the roofing class code. We want the additional premium. So there's really no way to get around that. You need to make sure that you're in the right class code. Shopping for business insurance isn't like shopping for auto insurance, where like Flo comes on with Progressive and says, we'll get you a quote in 5 minutes. It takes time. It takes maybe a couple weeks. Oftentimes there's applications, follow-up questions from the underwriter. And remember, the underwriter has a whole desk full of applicants ahead of yours, and they're trying to make every decision there. So you want to give yourself time if you're shopping for insurance, because otherwise they'll say, gee, it's just too close. We can't help you. It's too close to the deadline. Surplus lines versus the standard market. What is the difference? Standard market is like Travelers or Geico. But some businesses, because they're new, for example, they don't want that risk. They don't go, well, we don't know, you've never been in business before. So you end up going to what's called the surplus lines, which is the carriers that insure higher risk. Well, okay, if you've started your business and you're over here in the surplus, there comes a time when you want to get back over to the standard market because it's going to be less expensive. So please keep that in mind. Don't stay in the surplus market. If you can, move over back to the standard market. When it comes to workers' comp, remember that subcontractors are considered employees, okay? And workers' comp insurance will require you to add what you've paid to your subcontractors into your compensation for the calculation of your premium. Now, Virginia has a pretty unique situation. The officers of the corporation or the managers of an LLC can elect out of workers' comp. So if that officer is making $100,000 a year, we can actually elect for that not to be covered, for them to be excluded, and that would reduce your premium. Some jurisdictions like DC, they have a minimum. In other words, the officer is deemed to make a minimum salary, even if they're just a startup and trying to get started with their compensation. Also remember that in Virginia, it's only after you have more than 2 employees that you have to have workers' comp. But let's talk about that for a second. That sounds like a good idea. So in other words, if I have myself, 1 employee, and a subcontractor, then basically I'm required to have workers' comp. Why wouldn't you maybe consider getting workers' comp when you just have 1 employee? Let's talk about that. If that person gets injured and you're negligent, then your company is going to be liable. The workers' comp laws were enacted as a balancing. Before the workers' comp law, an employee who was injured had to prove negligence, okay? But they could get unlimited damages. The trade-off was, all right, you won't have to prove negligence anymore. You were just injured on the job. That's all that's required. But we're going to cap the amount of damages that you can get. So even though in Virginia I'm not required to have workers' comp if I only have 1 employee, it's not a bad idea to think about that. And also remember that if I have more than 2 employees, and that includes subcontractors, and I don't have workers' comp, the insurance commission is going to be very upset, and there are penalties and fines for running your business without having proper coverage. Finally, I'll talk about personal in a little bit. First of all, you want to bundle your home and auto. That can save you about 5 cents overall, 5% overall. Also, certain companies have pay-as-you-go. So if you don't drive many miles, that's a way to reduce your insurance costs. Also, certain insurance companies like Progressive, they have a device or a way of measuring what kind of driving you do. If you don't drive at night, if you don't brake hard, if you don't drive many miles, they're going to give you a discount. So that's another way to take a look at reducing your coverage. In your home, one of the damages that really drives insurance companies in a worry is water damage. Water damage. They're always very concerned about water damage. Well, you've known about smoke alarms and carbon dioxide monitors. Well, there are monitors for water. They're little devices. They are like a battery, just like your smoke alarm. You put them near where you might have water damage, maybe like your hot water tank or underneath your sink, and it will alert you when water comes in contact with it. And not only that, you can buy these so that it will actually tell you on your cell phone that there's something happening. Very important to keep that in mind. Remember how I said about how these insurance companies keep track? Well, they do. For example, let's say I go out and oh, lovely home, I'm going to buy that home. Unbeknownst to me, the prior owner has made multiple claims for water damage. Well, the insurance company goes, well, we're insuring the house, Artlander, and guess what? We're going to hold those claims that you didn't even know about when you bought this house that the prior owner made. We're going to assess that on your premium. You want to keep that in mind. Also, insurance companies, when it comes to home, they want to know when things have been upgraded. For example, the roof, plumbing, heating. And when you're a new homeowner, you don't always ask, hey, when was the last time the shingles were placed? But that would be good information to gather. So those are all ideas for you to save insurance costs and reduce your premiums. And I hope this has been helpful today. And if you have any questions, feel free to get in hold of me. Thank you and take care. Bye-bye.